Today, a litany of failures, more to come. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. More than 18 months ago, I started talking about the pressure that was building across the construction sector based on the results from my SME survey. And if you go back and watch some of Edwin's rants from last year, you'll see we revisited this issue several times, warning prospective purchasers to take care when contracting on new builds. Well, since then, we've seen an accelerated spate of building and construction firm failures, driven by the profitless boom, silly government stimulus, and intense supply chain and labour market disruptions. So it's a perfect storm of supply chain disruptions, skilled labour shortages, skyrocketing costs of materials and logistics, and, of course, those extreme weather events. But the seeds were laid months ago, and now we are just beginning to reap the whirlwind with more to come. The latest was Queensland residential builder Oracle Building Corporation, which went into liquidation on Wednesday, leaving 70 staff and 200 suppliers and subcontractors out in the cold, as well as 300 homes that were in the pipeline to be completed. Another Queensland builder, Bezzy Construction, collapsed only last week, owing $1.7 million. Earlier this year, two major Australian construction companies, Gold Coast-based Condev and industry giant ProBuild, went into liquidation. In July, Snowden Developments was ordered into liquidation by the Supreme Court with 52 staff members, 550 homes and more than 250 creditors owed just under $18 million, although it was partially bought out less than 24 hours after going bust. Others joined the list too, including Inside Out Construction, Solido Builders, Waterford Homes, Affordable Modular Homes, and Statement Builders. And then there was New South Wales building company Willoughby Homes, which went into voluntary liquidation. Also shuttered was Norris Construction Group, which was in Geelong, and they collapsed in March with $27 million in debt. It owes $3.2 million to around 140 staff that is unlikely to be able to repay, according to the liquidator's report. Plus, there was Melbourne-based company Blint Builders. They collapsed with approximately $1 million in outstanding debt, owed to 50 creditors, according to the liquidators. And Perth developer Cayden Urban killed off a $165 million luxury tower, where more than 50% of apartments had been bought off the plan, which was set to be one of the tallest apartment buildings in the state. Serona Urban owner Matthew McNeely said in July construction costs had risen by 30% in the past 10 months, while a shortage of traders were also causing problems. And in the same month, Melbourne developer Central Equity abandoned plans to build a $500 million apartment tower on the Gold Coast, blaming the crisis in the building industry and surging construction costs for making the project unprofitable. And earlier this month, a $180 million development in Brisbane, which was set to deliver 250 homes, was shelved by developer Cedar Woods, blaming rising costs, labour shortages, significant rainfall events in Queensland and extended construction timelines. One homeowner described the development company's decision as an absolute joke, claiming it would leave his family financially, quote, screwed. And many other Australian developers have faced difficulties in recent times, axing projects and blaming skyrocketing construction costs and labour shortages. But now, as News.com reported today, a collapsed giant developer, which went under with around 130 unsold apartments in Melbourne, has left behind a staggering $200 million debt, according to liquidators. The company was called Cayden, and it was backed by prominent figures in Asia, and it went into administration at the end of July. Despite boasting a portfolio of $4 billion worth of projects at one stage, according to the liquidator, the failed development company has now left millions in debt. It blamed COVID lockdowns and pricing factors for its demise and had an estimated debt of $200 million owed to its financier OCP Asia and $285,000 to Mercedes-Benz for a luxury wagon, a report to the creditor showed. It also had an outstanding tax bill of about $7.5 million and had not filed a tax return in 2020 or 2021, the report said, while 23 employees were also owed money, including one employee who claimed they were out of pocket by $21,000. While the developer made $3.7 million in pre-tax profit in the year to June, it was unable to meet immediate debts, and liabilities outweighed its assets by almost 3 times, the creditors' report revealed. At the time of its collapse in July, Cayden's managing director, Joe Ruzzo, said it had delivered 3,000 apartments, hotels and offices since it started, but it had faced a 45% rise in building costs over the past year. Sadly, over the last few months, Cayden has had to deal with one difficult market situation after another, he said. Pressure on construction costs resulting in building insolvencies and supply chain interruptions, and now the interest rate pressures and negative house price sentiment has placed additional pressure on our operations. Among Cayden's assets were around 130 unsold apartments at its home development in the affluent suburb of Alphington, which ranged in price from just under $600,000 to almost $700,000. There was also a significant land bank in the Melbourne suburb of Cremorne, where Cayden was developing a $1 billion commercial precinct at the site of the old Nilix silos, according to the Australian. Creditors' report outlined 43 unsecured creditors who were owed $15.6 million from the failed developer. That included $535,000 outstanding to law firm King & Wood Mallisons, $281,000 to real estate agency Knight Frank Australia, $124,000 to Deloitte Private, and $44,000 to Google. But there is still more bad news to come from here on, as we expect more firms to crash and burn, and we will then see what the contingency protections really are like. But I fear many prospective buyers will lose their shirts, and so this is a very timely warning to those thinking about contracting with building companies. It's essential to do your due diligence as never before, and make sure you understand the consequences should the builder go broke. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. The bottom line is you could lose a lot. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.